Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined once again by our Global Head of Macro, Tactical Asset Allocation and Alpha, Haydn Davies. Good morning, Haydn.
Good morning.
Okay, so let's kick off straight away. Inflation has been falling worldwide and interest rates are generally the highest we have seen in 15 years. After the Bank of England's decision to hold rates this week, are central banks ready to call it a day?
Well, if they're not quite ready to call it a day, they're certainly very close to being able to call it a day. So it certainly looks as if we're very close to the peak in interest rates. And I guess that's probably most true in the Eurozone. So the European Central Bank has pretty much indicated with its last interest rate rise that it probably doesn't think it needs to go any further. In the case of the US Federal Reserve, they decided to pause on raising interest rates, but it was what economists call a hawkish pause because they indicated they thought they might need to change interest rates again in the future. And remember, in the case of the US, they actually paused earlier in the summer only to resume raising interest rates a little bit later. In the case of the UK, the Bank of England, again, like the US Federal Reserve, paused, but perhaps gave a sort of a broader indication that it thinks its job is done in terms of raising interest rates. So it certainly looks as if we are sort of at the end of this stage of the interest rate cycle. The markets certainly seem to be coming around to that view as well. So market pricing in the money markets really is that the US Federal Reserve isn't going to raise interest rates again. The European Central Bank isn't going to raise interest rates. Maybe the Bank of England will be forced to raise interest rates again. But the market's really in sort of two minds about that. So yes, it looks as if we're at the peak in the interest rate cycle. I suppose the caveat, the health warning here is that central banks have been saying, well, we think we're close to being able to call it a day, but do not expect us to start cutting interest rates anytime soon. So they are winning the inflation fight, but the inflation fight is not quite won yet. So obviously in the UK, inflation has been coming down. It's been coming down since October, but it's still pretty stubborn at just about 6.5%. So much higher than the Bank of England's 2% target still. In the case of the US and the Eurozone, US inflation is between 3.5%, 4%. Eurozone inflation is about 5%. Again, inflation rates have been falling since October in the case of the Eurozone, June last year in the case of the US. So central banks have made progress, but the point is inflation is still above their targets. And from here, inflation is expected to fall more gradually. So I suppose the last mile of any race is always the hardest, and it's also the case in the battle against inflation. And so the likelihood is that inflation will still be above the US and ECB targets at the end of the year. It'll certainly be above the Bank of England's 2% target. Economists think that inflation will be just under 5% in the case of the UK at the end of the year. So the battle is not won, which is why central banks are saying don't expect us to cut interest rates anytime soon. And indeed, inflation is sort of not really expected to come down to the central bank's 2% targets until perhaps the middle of next year. And I suppose let's put things in context. Obviously, at the start of last year, interest rates were pretty much zero, below zero in the case of the Eurozone. Now we're at above 5% in both the US and UK, and 4% in the case of the Eurozone. Economists probably think in general that a reasonable level of interest rates, if inflation is under control and back at central banks' target rates of 2%, economists think that the interest rate sort of compatible with that, consistent with that, is probably in the region of 3 to 4%. So central banks at some point will be expected to start lowering rates to levels in the region of 3 to 4%. That's what sort of what be consistent with the inflation targets in the long term. But because the inflation battle is being won, but not quite won and finished and done and dusted yet, central banks aren't in a position to start cutting interest rates to those sort of lower levels. So in the long run, investors and savers should probably expect interest rates to be in the region of 3 to 4%. So lower than they are now, but of course much higher than we have seen over the last decade or so. So the underlying message is, yes, we're pretty much close to the peak in interest rates, but it's going to be a while before we start to see them fall.
Excellent. Thank you, Hayden. So on the back of that, even though inflation has been falling, and as you say, markets think interest rates are near or at their peak, stock markets have still been struggling recently. Why is this?
Yeah, that's a good question. So obviously you would think that with inflation falling, it peaked at 9% in the US last June and is now 3.5%. In the case of the Eurozone, it peaked at 10% in October and it's now half that level, and sort of a similar story in the UK. That would be good enough for markets, especially with the sort of the peak in the interest rate cycle in sight. I suppose there are sort of several reasons why markets have sort of struggled a little bit more since over the summer. So despite that good news, so let's start with the growth story. At the start of this year, economists were forecasting the UK economy to shrink 1%. They were expecting the Eurozone economy to shrink a little bit, and pretty much no growth in the US. And of course, the story has been that actually all the economies have done better than expected, despite the rise in interest rates that we've seen. So the US economy, instead of barely growing, is expected to grow 2% this year. The UK economy, instead of contracting 1%, should grow about half of 1% this year. And the Eurozone economy should similarly grow about half of 1% or so this year. So the growth picture for this year has improved. And to some extent, that drove the rally in equity markets that we saw in the first half of the year. Now, whilst economists have upgraded their forecast for this year, that's sort of come at the expense of growth next year. So they've been downgrading their forecasts for growth next year. So the US economy is expected to grow about 1% next year. The Federal Reserve is a bit more optimistic on that, but economists in general disagree with them. And the Eurozone and the UK are expected to sort of deliver pretty meager growth next year, and less than people were expecting or forecasting at the start of this year. So the story is that this year has been better than expected, and that's to some extent that's reflected in equity market movements and valuations. But next year is looking less encouraging. And I suppose that's one of the reasons why markets perhaps have taken a little sort of a step backwards since the summer, because the growth outlook for next year has deteriorated somewhat. And it's worth bearing in mind, of course, that markets got off to a pretty strong start, right? They raced ahead at the start of the year. They're up about 15% in the case of the Eurozone, the US and Japan, which was probably they got ahead of themselves a little bit, given the interest rate outlook, given interest rates were still rising, given we've got the highest interest rates in 15 years, notwithstanding the fact that the growth outlook for this year had improved. So I think it's natural that markets have taken a sort of a pause for breath, given that strong start to the year, and given the fact that growth for next year is looking a little bit sort of more disappointing. I think there are other elements to the story of why markets have perhaps struggled a little bit during the summer or as we go into the autumn. One of those is the oil price. So a good reason why inflation has come down is because oil prices have fallen quite noticeably since they peaked in the aftermath of the initial invasion of Ukraine by Russia. However, since the summer, oil prices have been rising. That's because OPEC and particularly Saudi Arabia have cut supply. They're trying to push up the oil price. So oil prices are rising, and given that has been actually in recent months been helping to actually bring down inflation, that's one reason why markets are a little bit anxious, because this, if sustained, and the point is that this rise in oil price needs to be sustained. If that's the case, then that would make it harder still for central banks to go from where inflation is now, which is close to target but not close enough, to actually getting inflation down to target, and sort of reinforces the impression that interest rates would have to remain higher for longer. Now, of course, if oil prices recede from here, then that stops being such a concern. But certainly a lot of followers of the commodity markets and the oil market in particular think that OPEC will maintain those cuts, and oil prices will generally continue moving higher. In the case of petrol in the UK, for example, petrol prices have already risen 10% in the last month, reflecting that. And of course, that is bad news, particularly for the Bank of England's inflation fight. So oil prices are sort of an eye in the ointment, if you like to put it that way. So that's another reason why markets have been struggling. And to some extent, the third reason is China. So a lot of watchers of markets have been focusing on China this year. At the start of this year, China came out of its series of lockdowns that it had been having since the outbreak of COVID, and opened up the economy. And economists expected that to lead to a boom in Chinese growth, a boom in world trade, and possibly also stoking up inflationary pressures by pushing up demand for commodities. That hasn't happened because of the problems in the real estate market there, that China sort of has had a bit of a bubble in terms of building and construction, and that's been a key driver of Chinese growth over the last, well, 15, 20 years. And perhaps it's been too much of a driver of growth. And now that the construction sector is contracting and certainly under pressure, and problems of developers failing with leaving a lot of debt, that is a drag on the Chinese economy, and it dampens some of the enthusiasm and sort of the hope for this year and next year in terms of world growth. So just to summarize, why have markets struggled since the summer? One, perhaps they got ahead of themselves, given they rose quite strongly in the first half of the year. Two, China has been a disappointment in terms of the economic progress and growth. And three, well, central banks are expected to continue to keep interest rates at the highest levels for 15 years or so, for certainly well into next year, at the same time as the growth outlook for next year is deteriorating, or certainly forecasts are being revised down. So all in all, this year has been better than expected, but the problem is that markets are now sort of forgetting this year and looking forward to next year, and next year isn't looking quite as good as they had hoped.
Excellent, thank you. So bearing all that in mind, Haydn, how are your portfolios positioned as we head into the autumn?
Well, we haven't really been making many changes. So what we've been saying for a little while is what we still believe is that, given that we are close to the peak in the interest rate cycle, that's the time at which where bonds become more attractive. We've been saying for some time that if you buy bonds, or don't buy bonds, I should say, don't buy bonds now, you're not going to miss out on a rally, because central banks aren't going to be cutting interest rates very quickly. They're going to be keeping interest rates at these levels for some time. So you have time to wait. So we're still of the view that it's a good time to add bonds to the portfolio, but probably, again, because central banks won't be cutting interest rates until well into next year, you still have time to wait. So you can just add bonds to the portfolio. So we're positive on the outlook for bonds, as we have been for a little while, but we would emphasize that if you don't buy them today, you won't miss out. In terms of the equity markets, I suppose we're a little bit more neutral, and have been over the summer, partly because markets have done so well in the first half of the year, partly because the growth, or the immediate growth outlook, is a little bit softer. But at the same time, valuations, particularly in Europe, the UK, for example, are very attractive. So whilst the sort of the immediate growth outlook raises some headwinds, I suppose, for equities during the autumn, looking a little bit further ahead, and the prospect of central banks cutting interest rates, that would certainly be good news for equity markets. So we're sort of neutral to a little bit cautious in the short term, much more optimistic about the medium term looking into next year. But certainly bonds is our preferred asset class at the moment.
Excellent. Thank you, Haydn, for such a detailed update. So thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require guidance or advice, we would recommend you contact your professional financial advisor. Thank you once again for listening to our podcast, and we look forward to speaking with you again soon.